Closed captioning of this program is brought to you in part by thefundindustrymustchange.com. It's time for the change investors need.
We'll get back to the calls and emails in just a second, but we want to remind you that you can get the top picks and past picks from our great roster of guests here on Market Call and Market Call tonight, sent straight to your inbox every night. BNN is doing that, along with the analysis from our guests and some commentary from Marty Say as well. You just have to go to bnn.ca/subscribe to sign up for our nightly newsletter. Now, moving along, here is an email from Ryan, who's in Saskatoon. This is on BioX Specialty Proteins, BXI. I'd like to know your opinion on this company with the recent shutdown and startup of production. What is your long-term outlook of their product? This was a high flyer for a while, but they've run into some trouble, haven't they?
That's for sure, yeah. So they do extract high-protein, high-value proteins from canola. And, yeah, we did own the stock. Luckily, we got out near $2 a share. I mean, it sounded great and everything, but they've had a lot of problems with startup problems, cost overruns, production's been below expectations. And then they had to raise money at $1 a share. You know, my view is the stock may be completely bombed out and maybe it's just the wrong time to sell. But what I would say is, you know, we've been in a very tough market, and personally I prefer to buy stocks that aren't having any problems, because a lot of them are trading very inexpensively. I mean, I could buy this, which has had its problems, and maybe it'll get things moving again in the right direction. And, you know, it sounded great all along, but they have had, to my mind, too many problems, and the stock price does reflect that. So I prefer to buy companies that haven't fallen as much but have had fewer issues or no issues at all.
All right, Alan, here's a call from Mike, who's in Montreal. Good afternoon.
Hi, guys. Thank you for taking my call.
You're welcome.
My question is on Orbit Exploration. Just wondering your guest opinion if you would consider it here at these levels, and if there's any more downside risk at this price, trading below $2 right now.
Yeah, Orbit, luckily we got in on the issue a year ago at 45 cents, which had a half warrant, and the stock had a big run, and I must say I did sell the majority of what we own. We still do have about a 1% position. I mean, they have this patented process to make alumina, including high purity alumina, from clays in Quebec, and there's huge demand for alumina, both from the aluminum producers and for high purity alumina. So what I would say is, you know, it's got its risks. The market cap's a couple of $100 million still, and it doesn't have sales and earnings yet. But they've made enormous progress on with their pilot plant and with getting various environmental approvals and such like. And there was another announcement today where they are keep moving forward. So I think it's an interesting company. I saw today someone came out with a target of $13.50. I mean, I discount that big time, but at $2, it's probably reasonably good value. But sure, there's downside risk because of the nature of the stock market and the fact that the company is still, you know, I won't say it's a concept stock, but it doesn't have any sales yet, and that's still a ways away. But it sounds like a great project. I think the management's excellent, and the technology looks extremely good, and there's sure a big market for alumina, because at the moment they have to import it from Australia and Brazil and Guinea, and it costs a lot of money to transport it to Quebec, where there are a lot of aluminum power plants.
All right, Alan, I know your colleague Eric Nuttall likes this next one here, Open Range. Jeff, with an email just basically asking what's your opinion of Open Range, the energy company?
Yeah, I like that a lot. It's been a big win. But not only did I own it before the announcement of the spin-off, but where they're spinning off their oilfield services company and the gas company are going to be in two parts. But I actually bought more after they made that announcement. I think the stock went from about $6 to $9 on that announcement. So the excitement with this is that 18 months ago, this was a low operating cost gas producer. And then they started this energy services company, which has storage tanks, fluid storage tanks for fracking, and the business has just blossomed, to put it mildly. It's grown exponentially, and the run rate for the EBITDA is about $100 million a year. That business didn't exist 18 months ago. So they're hiving that off, and they'll be paying a dividend of $1.08, which per Open Range share works out to about 93 or 94 cents. So if you buy Open Range at $9.50, you can say it's on a 10% yield, and you get the gas business for free. The gas business is probably worth $3 or $4 a share. It's growing very, very quickly and a very low cost. So maybe at a 10% yield, the business is worth $9 or $9.50 plus $3 or $4. I think together it's worth about 13. So I'm still very positive on it, and it's I think it's our second biggest holding after Glentel. So even, the stock's probably discounting about a 12.5% yield, which for an oilfield service company that's in the forefront of a business which has huge potential, I don't think it'll be on a 12.5% yield, but that's kind of what it's discounting today, maybe even 13% yield. And that spin out is going to happen, I think, at the end of October.
All right, nice detailed answer there on Open Range. Let's look at an email from Greg on Lakeshore Gold, LSG, and the TSX. What are your thoughts on this company? They had some production problems a few weeks ago up in Northern Ontario. And got
yeah, they've had quite a few problems and also very high operating costs, mainly at the Timmins mine. I sold this company a couple of years ago. It was over $3 a share. It probably had a premium rating. And when you look at it today, you know, again, if they hadn't had any problems, the stock would have probably fallen 20 or 30% from the peak, but it's actually halved. I think it's looking quite interesting because despite its problems, it has several million ounces in resource, and it's in Ontario, and the production, the growth profile is very significant. So I think this company looks interesting. We don't own it yet, but it's sort of on our radar screen because I think despite its problems, they're at least more than discounted in the price, and there's a lot of potential, you know, not 5 years out, but in the next year or two for this company to improve matters. But they are working on a revised mine plan, and I sort of come back to what I said before. I prefer companies that haven't stumbled. In this case, it's probably over-discounted in the stock price.
The stock went from 340 to where it is now 153 in just a matter of several weeks. We'll take a short break here. We'll come back with Alan Jacobs. We're going to take a look at his top picks and also his past picks. That's coming up.